Hello, everyone, and welcome to another market update Friday afternoon here on a beautiful day in the Midwest. So thanks for joining us today. And with me, as we have throughout this challenging time, I have Beth Foley coming to us from up in Royal Oak, Michigan, and Bill Davis and Matt Aurenz as well. And we continue to practice social distancing and having our team kind of spread out and being able to continue to provide service. So we wanted to kick it off with a little bit of fun today. First, if you remember, you saw this chart a few weeks earlier, if you were with us or you happened to watch the replay. So it kind of shows relevant importance over this time since the beginning of the year. And you can see that with everyone being at home, internet went up, alcohol really jumped. And of course, sweatpants went up. And guess what? Having a car was not as much of a importance for folks, so that really went down. And now we have the need of masks, and we're further along. Here we are almost halfway through the year, and so we wanted to show you kind of some more relative importance. And so look at this here, the mask. And yes, that is not drawn by a young child. This is actually the map, and you can see how it's all over the place. Maybe I should, maybe I shouldn't, maybe I wear a mask. And of course, it's jumped here as of late. So kind of a fun chart to see relevant of importance in 2020. So let's go through our agenda today and what we wanted to cover with everybody. We had 4 key points we wanted to talk about today. The first one is job and unemployment reports. Secondly, in the job and unemployment, we certainly got some numbers. We get some every Thursday, and then we had the jobs report come out last week. So we'll make comments on that and kind of how we see that may affect things moving forward. We have a statement here. This is what we talked about. So if you've been following along in these webinars, you know that we did talk about, look, we've had quite the run in the market, but things are not over. And so we just want to talk about that. We're not saying we were right. We're just saying that, hey, there's certainly challenges still to come as it relates to the markets. Fed activity. So we're going to talk briefly about what the Fed has stated or said and what maybe Congress will do. And the Fed continues to step up to the plate as needed, and will continue to do so. And so we're gonna talk about that a little bit. Then we're gonna talk about real estate and housing and what we're seeing there. So to kick it all off, we've got this chart. It's got a lot of numbers. For those of you that are calling in, I do apologize for that, but it shows the difference between a bear market and recession. And so maybe, Beth, I'll let you kick off things and kind of explain to our viewers this chart and maybe how we're thinking about this.
Yeah, I kind of drew the short straw on explaining all of these numbers in here. So we're looking at bear market and recession. And really, we just wanted to use this graph as a place to kind of level set as to, where we're at and where we are in context to other crisis timeframes or periods of pullback and recession. And so on the left-hand side of the graph, you see bear markets going back to 1948, different periods of bear markets. And if you look at the third column under duration, you're going to see for the most part, they lasted a pretty good long time. In many cases in excess of a year or two, except for that period of 1990, from July of 1990 to October, where the bear market or a contraction of the S&P 500 lasted only 87 days. Other than that, I mean, if you look at 2000 to 2002, 3 years with an S&P 500 contraction of negative 49.1%. So when we look at the time frame that we're in right now, when we look at the bear market going back and saying, or when did this contraction of 10% or more start? February 19th. Which happens to be a significant day for somebody participating in our call today. So February 19th of 2020 to May 29th, that's only 100 days. So where we stand right now with the market having gone through its recovery, this was one of the shortest bear market periods going back to World War II of just 100 days. Now, to level set, if we look on the other side with the recessionary periods, again, going back to 1948, we see periods in months. So I think last week with the markets booming and going back to where they were before this all started, maybe got some juices flowing, thinking, hey, we're going to get through this. It's going to be great. Everybody's going back to work. I can go out to eat, all of those sorts of things. But if we look at historical reference for the length of a recession, in a matter of months to a year and a half or so, we don't yet know how long it's going to take to recover from this. But if we set expectations in a realistic sense, it's not going to be a matter of a month or two or just get through the summer and everything would be okay. And remember, these were economic conditions, which we have, but we also have this huge medical and health issue going along with it that still has some unknowns. So I think just putting it into context of where we sit right now and what historically has happened, no guarantees that what's happened in the past will happen again, but just to have a better understanding of how long it can take to recover from situations like what we're going through right now, Erik, is how I would approach this graph.
Yeah, thanks, Beth. And I would think that if we ran a poll on this and said, what has been the average bear market since 1948 in the amount of days and gave them a choice, I don't think many would think that it would be actually 517. I mean, that just seems like a really long time, but I think this chart does point it out. So, jobs and unemployment, Bill, we've talked about it multiple times on these webinars. When we first started these back in March, I mean, it was large numbers. It's going down a little bit as far as the unemployment numbers, but certainly still large numbers.
Yeah, at least positive numbers to report. Last week there was only I say this, with sleight of hat here. Last week, 1.5 million new unemployment claims. But what was really shocking to the world was the non-farm jobs rebounded 2.5 million people, and that estimate was going to be a negative number. I just remember last Friday that, everybody was just jumping out of their shoes because of that report. So unemployment rate fell. The actual statistic they're using is 13.3, but we believe it fell from about 20 to 17. And something interesting that I haven't researched yet, I'm going to this week, is, only 10 million, just short of 10 million people are receiving the PUA, which was the pandemic unemployment assistance, which was the extra $600 a week. And that just is it seems like a low number, whether there's states that are holding it up or what, I don't know. But I also know that PUA payment is bringing some people's weekly compensation to a level greater than what they were making prior to their layoff. And then the last stat that kind of stood out to me was that almost a third of the people on unemployment are in the food related industry. And so when I think about trying to bring back restaurants at 50% capacity, we had a local brewery here in Napanee that opened up, and then one of the employees tested positive, and now it's shut down again. So, they only started at 50%. They operated about a week or two, and then they had to shut it back down for cleansing and make sure everybody was tested. And I think they're just going to go through the 14-day wait period. So I think opening up the food related industry is going to take quite a bit of time yet.
Yeah, it's funny you say this morning, I went through Panera to get a bagel, like I do often. And, Panera's, I think anybody knows when you typically go buy one, especially, all day long, the lot's full, the drive-thru's full. And there's a big sign that says, the dining room's open, and there were 2 cars. And the drive-thru was pretty full, but again, they're just not up to capacity yet. And again, it's going to take a while. And, we also talked about the effects the things that we haven't seen. And Matt, we talked about the airline industry, and right now, they really haven't laid off, but they're going to start it. So, there's more to come, unfortunately.
There's a lot more to come, and we just don't know, the severity of what that's going to look like. I think you'll probably see certain industries that does have a severity to it, and others that aren't going to be influenced as much. So we'll see. I think now you've got protests and riots all over, and so we don't know what that data is going to look like, and if COVID's spreading through that, and um, you know, Seattle's kind of got an autonomous zone where they've taken over parts of the town, so those businesses are shut down. So there's just a lot of uncertainty out there right now, and so I think we're saying, hey, just continue to tread with caution. We're not through this yet.
Yeah. Good. Well, then that leads us into the next statement or topic we wanted to talk about, and we just simply put, this is what we talked about. So I'll throw it back to you, Beth. So what's happened with the markets, and we saw many weeks of up, the best April. Then there's the saying of sell away in May, go away, right?
Go away,
Sell
that's
go
right.
away.
Yep.
Sell and go away. So, but really, we saw some volatility yesterday, and we have been talking about this as well on the webinars.
Yeah, we have been. And, I think that we've also said all along that before all of this started, going back to February, January, and so forth, the economy was relatively strong. We were having good economy and, really low unemployment. There were lots of really great fundamentals going on out there. And then we got hit with this unprecedented event and how we react to it. And so we've been talking about how the stock market is disconnected from Main Street. The stock market is not Main Street, is not the economy. And I think we just got a whole lot of momentum buying going on in the markets. And that was, pushing we talked about price earnings ratios and, could these prices be maintained? And we talked about computer trading and all of those sorts of things. And I think that what we've seen is kind of that all coming together of, people are going to go back to work. That's going to be good. We're going to see some unemployment numbers coming down, but people are going to go back to work, and we're going to see some more infections happening and maybe see a rise in cases again. And I think that all just kind of came together over the past few days. So, we had good news last Friday. We saw this huge surge in the market. With the economy going up, but then, the impact and to Matt's point with the new infection rates, well, 2 weeks ago was Memorial Day when a lot of states opened up again. We saw lots of people getting together and seeing friends and family and socializing again. And now we've got another wave of infections, which, was could have been expected from all of that. So I think we've got a lot of momentum that pushed prices up, maybe taking a little bit more of a realistic look at things at this point in time too. So we talked about, what kind of recovery are we going to have? Is it going to be a V? Is it going to be a Nike swoosh? Is it going to be a W? I think that a little start and stop, stick to fundamental investing, be cautious is what we've been saying. And I think this week proves that out, to be cautious.
So yeah, that's good, and we have talked about that. It's kind of changed a little bit, right, from a W to a swoosh to back to a W. So, Bill, I know we talked about kind of three potential headwinds. There's more, but three kind of major headwinds that could get in the way of this economy kind of turning around and making a swing to the upside.
Yeah, one of them's a pandemic spike, and that happened, right? We got a spike, and the market went down 7%. I mean, that was exactly what we talked about could be a risk. And that, the next is economic risk, that we may not get out of this economy as quickly as we would like. We may not get this economy going as quickly as we would like. And then a lot of people haven't even paid any attention that it's an election year. So I think we face some political risk in that they're going to go back to Washington next month, and I know the first thing that they're going to talk about is more stimulus, and where's that going to go, and who's it going to go to? Is it going to go to municipalities? So we got three pretty big potential headwinds in our face. Yes.
Yeah. Any additional comments on that?
Yeah, I think what you're seeing right now is just a ton of momentum, or what we've seen was a ton of momentum. You're even hearing a lot of articles just talking about people interested in fractional shares and the need for fractional shares and stock buying that's increased because they they can't buy the Amazons at $1,200 a share, $1,800 a share. I only got $400, but how do I own Amazon? So you're looking at those types of things. You know, you're seeing Hertz Rental going through bankruptcy, and the stock's up almost 600%. Cruise lines, airlines, they're not flying anybody. Cruises are still at port, and they're up 100%. You know, in the last 2 weeks. So I think a lot of what we're seeing driven is day traders. We talked about smart money, dumb money. We're seeing a lot of the dumb money, if you will, just people chasing returns, people chasing momentum, people, you know, fearful that, hey, this is easy. I can make a killing. This is no problem. Investing is easy. I just got to pick what's moving. And you know, there's a lot of people coming out with press comments about how they're smarter than Warren Buffett, and you know, so those types of things. We're just saying, hey, it's going to be short-lived. You might make $1 today, but you're probably going to lose $10 tomorrow. So let's not get caught up in that.
Yeah. Well, so then we move on to the Fed and the activity there. And the Fed chairman has been certainly, they just came off a 2-day Fed meeting and debrief. By the way, on our website, our new website, so I will plug that if you have not been on there. I'd spend some time on there. You know, on that website, you'll be able to find some guides and checklists that may help you, and we're going to continually update that. We have a market volatility center, and we've put a couple clips of recent, somewhat recent. One of them was the Fed chairman speaking on 60 Minutes. It's an interesting clip, and you could watch that. But, you know, the Fed has done a lot, Beth. They've done a lot, and there's probably almost for sure more to come.
More to come. The Fed has been assertive and quickly assertive, and I think, you know, not trying to gaze into a crystal ball, but when we look back at this period of time, a year or two from now, I think the Fed is going to get accolades for helping us through this so quickly. So the Fed did meet this week. My favorite phrase coming out of the Fed meeting was that Chairman Powell said that the Fed isn't even thinking about raising interest rates. And so, you know, they're just saying, and they said it could be another couple of years. And if you remember back in 2008, 2009, 2010, same thing, that there was no discussion. You know, they flat out said, we are not raising interest rates, because the whole idea of keeping interest rates low is to kind of incent businesses and people to spend money. And we need to, you know, keep money off the sidelines and working, whether it's through capital loans, individual loans, real estate, whatever the case may be, to keep that money circulating. And the other thing, I found this article, a summary of the Fed meeting, that under some consideration, I would say, is implementing and using a tool that has not been used in the United States since the end of World War II, 1947. And at that time, this kind of relates a little bit to our conversation last month about whether or not we would go to negative interest rates, which they have said, no, we're not going to do, but under consideration maybe when the Fed gets going again, is whether or not they would cap interest rates on medium-term bonds. So setting a cap so that yields can't go higher, and as a disincentive for people owning bonds or keeping money on the sidelines, if you can't get a decent yield out of it, you're going to look for someplace else to spend your money. And the objective here would be to get people to invest more in equities, to spend money, to borrow money. They're actually looking, and they have been looking for, you know, over a year to kind of juice inflation, get prices moving upward again, which is beneficial. It's not always, you know, a good thing to have prices flat or going down. So that might be something to watch for with the Fed and other actions that they may take. They've said they're going to pull out every tool in the toolbox to help this through. And this could be a unique tool that hasn't been used for, you know, 80 years, to see if that would help the situation. I think that goes along with, you know, when Congress and everybody gets back into session after the 4th of July holiday, to see what may happen, to Bill's point, with additional stimulus packages, continuation of the stimulus, the unemployment, extra $600 a week. So just kind of keep an eye on what's going to happen in Washington with the Fed and Congress going forward.
Yeah, it's a great point. And, if you do watch that clip, I mean, it does, the Fed chairman does talk about that there are many more tools. As Beth said, they have many more tools in the toolbox. I heard an interesting comment from one of the folks we follow recently that, Chairman Powell is not an economist in training, from a background of economy. And you put that along with the experience that the Fed had, because there's a lot of people within the Fed that had experience in 08, 09, and it probably equated to this, going back to that chart, Beth, that you referenced, the shorter duration of the dip in the markets. So, yeah, I think that's a part of it. So, well, it's kind of interesting because I think that, there are the businesses that are unfortunately struggling. We're seeing bankruptcies, closures, and so forth. There's also the business that is not struggling, and that is real estate. And Bill, we've seen, just a spike in people kind of getting back into the buying of real estate.
It really amazes me that at a time in our economy where people are getting furloughed, people that didn't think they would get furloughed are getting furloughed, and the houses are just flying off of the shelf. There's no inventory in the best school systems in America, and it's crazy. It amazes me. Now, one thing that could be driving it is people don't want to live in the urban lifestyle anymore, because if this is, we don't know what the new normal is going to look like in our world. And I think people are like, boy, I wish I wasn't sheltering in place in this 900 square foot apartment. And, I have to go in an elevator to get up and down. And they're, trying to get out of the urban landscape and get to the suburbs. That could be the case. But yeah, real estate is going crazy.
Yeah, for sure. In fact, we wanted to show a chart here that shows kind of savings rates. And so, Matt, maybe you can go over this. And I don't think you need to really be a chart reader to see that the blue line has just skyrocketed up.
Skyrocketed. Part of that stems from the ability for people not to get out and spend money, right? So they're just saving. Some of it's the uncertainty of how long is this going to last, and I better pad my savings up, and so they're saving more there. And I think some of it stems from definitely people who were already savers, maybe furloughed. Some of those people were making more money being furloughed or unemployed than they were while they were working, so that influx of cash they're saving. I think just most of it attributes to people just not spending money on unnecessary products. And, they're not traveling, they're not, they're not going clothes shopping like crazy, those types of things. They're not out spending money on restaurants. And, you take those away, those are the big spenders, big expenses that people with their discretionary income are using. And so when you're not filling your gas tank up, all of a sudden you got an extra couple $100 a month there, so that's really what I think we're seeing here. So you got a couple of things. You either got people who are using that and investing it in the market. You have people putting in savings, and on some level you'll have just this pent up reserve of cash that people are going to say, all right, well, now that we're open and clear, I'm going to go spend it all. So that will definitely help the economic activity once people do get out and some of those people do spend. But I could see people long-term saying, oh, I didn't need all that stuff. What's it look like to modify my lifestyle a little bit and have a better savings rate and not be caught up in all that, keeping up with the Joneses?
Do you think the other thing we'll probably see if we dug down into this, there's going to be this pent-up demand they talk about. There's going to be some of this like in travel and some other areas as well. This would be for anyone on the panel. I think there'll be some of that once we get to a point of travel safe. We're going to see some people are going to be anxious to go.
I think people are going to be anxious to go, and I think there's going to be some deals out there to take advantage of as well, especially for, kind of the early adopters who say, well, you're not going to catch me on a cruise ship. But for those who say I can I'll put on a mask, I'll wear my glasses, I'll get on a plane and I'll get off a plane. And if I can, fly across the country for a couple $100, I'm going to take advantage of that. So I do think there's going to be some pent up demand, and I think it really is going to be in the travel and leisure part of the economy for that. And I agree with Matt. Absolutely. I think that when I talk to friends and family and clients who have found, they've kind of found a little, I'm going to use this word because it's going to connect to something we're going to say in a minute. They found a little bit of bliss in not having the kind of consumer driven demand. I need this, I have to have this, that we might see a little bit more savings and a little bit less spending as people simplify and have found a way to simplify their lives.
Yeah, I mean, I laugh, Beth, because my kids, they need clothes that fit them, because their summer clothes from last year don't fit. And I tell my wife, well, we'll just go to the stores. Like, there's nothing on the shelves at these stores, and I'm not going to order a whole bunch of stuff on Amazon and have to go through the process of returning it. So they're not going out to see anybody. They can look like hooligans. It'll be okay.
It'd be interesting to see a similar chart, if we could find a similar chart in a few months that we showed when we opened up the webinar. So let's go on to kind of our key takeaways. So the first off is the digging is not done. Bill, so what does that mean?
This is not over, folks, but I needed to do a disclaimer here. I'm sure that Beth will be the first one to find the best deals to travel the world, since she is our world traveler. So I'm sure that she's on the travel sites all the time, checking out how she can get to someplace in the world. The digging's not done. This is not over, folks. We are just in the first inning of a 9-inning game that is going to take us a while to recover from. And until we can have some certainty about, what 235 or 240 biotech companies are working on. I think we announced at one of our calls or one of our shows this week. That's a lot of energy being put into trying to give people the certainty that they can go out and spend on this economy. So we got more to go, and do not be surprised if you see some more market pullbacks, because we're riding on stimulus money right now, and there are no fundamental. There's a lot of companies that don't have the fundamentals to back up their stock price.
Yeah, good. Thanks, Bill. So watch what the Feds and Congress do over the next few weeks. Beth?
Find my microphone. Yeah, so there's more to come. We're not out of this yet. The digging isn't done. And the Fed is very interested and is, as I said, being assertive about finding ways to get us through this. And Congress, we've got the HEROES Act coming out of the House. The Senate hasn't taken it up yet. We add in the flavor of Matt's point or Bill's point about being that we do have an election year, as if we'd forgotten about that. And politics is going to come into play. There's going to be some headbutting going on. So just keep an eye on that, and pay attention, because the media still has to sell media. And to me, it's really interesting that the New York Times has had a couple of pieces of, your next stimulus check hasn't been, well, there is no next stimulus check yet. There's nothing that's been agreed upon. So keep an eye on what's actually happening and how it might influence how we continue to recover from all of this over time.
Yeah, I think Bill's words were the other day, right? That, we haven't even started really. I mean, normally the old election year, we're already hearing it. Well, with everything else going on, we got all that to deal with, I think was Bill's kind of phrase on that. So, all right, the last point. Yes, that is a word, hopium. Don't ride the wave. So, Bill, I know you want to talk about hopium. I don't know where we came up with that word, but we thought that'd be perfect to put into the webinar.
Yeah, I did not pen that. That came out of a Charles Schwab article this week. Okay. And, it's two words put together, hopeful and opium. And we know if you smoke opium, what that'll do to you. And we think way too many people have taken this hopium drug, or they're on this hopium ride. And we're saying to our clients, please stay off the wave. because it's not going to get you where you want to go in the long run. That stay off the wave.
Yeah, and I think back to what you said. There's some people now proclaiming that they're better stock pickers than Warren Buffett, and don't listen to Warren. Yet Warren's a top 5 investor in the world, certainly one of the wealthiest people in the world. So, but they tend to self-proclaim themselves on this hopium.
Crazy.
So good. Well, thank you everyone for participating, and thank you for joining us. A couple key things I want to bring up. One is we want to remind you that we have our Together We Can Make an Impact campaign going on to try to help those that are hurting and in need from this COVID-19 pandemic. And so if you donate to one of these organizations and you send us your receipt, we want to provide a match for that. We want to make sure we help out. Yeah.
Erik, can I say something real quick?
Sure.
So I wore this sweater intentionally today. This was a fundraiser. A portion of the proceeds went to COVID relief efforts. And I wore it intentionally today because I know the clients are out there, and I think just wanted to say on behalf of Bill and Matt and Erik, thank you for the trust and confidence that you've put in us to help you kind of get through all of this over the past couple of months. So it was intentional, and I just wanted to say thank you on behalf of all of us. And thank you for all of the donations that we've been getting for our matching program too.
Great. Thank you, Beth. Thanks for that. And we certainly appreciate it. Also, we had a couple weeks ago now, we had Robert Siciliano, a cybersecurity expert. We had great response to that. But if you did not get a chance to watch it, you can go on our website and pick it up. And if you want to get his book, you can request a book on there. The last thing I'll say is that we also have had great response and feedback from our weekly show that we're doing. So it airs, if you're in the Michiana area, it airs on Fox Michiana at 9:30 on Saturday mornings, every Saturday morning. If you can't catch it on Fox, make sure you catch it online or on Facebook. You can catch it there, and certainly you could catch the replay as well. Bill and I had the fortunate, we were fortunate to interview this week, that will show tomorrow, Ed Slott. Ed Slott is, you may have seen him on public television. We, as advisors, are part of his Elite Advisor program, and he'll talk more about that. But he's very knowledgeable. He's called the retirement expert. And so very knowledgeable. So catch that tomorrow or catch it online. So with that, I'm going to say goodbye. Thank you from Bill, Matt, Beth, and myself again for being a client. Thanks for watching, and hope everyone have a great weekend.